All right, let's go. Hey, Miles. Hey,
Hey,
everyone. Everyone, thank you for joining on this beautiful evening. It is 6 p.m. New York time. I'm probably guessing it's 5 o'clock somewhere. So
yeah.
hold on to your glasses and enjoy the ride. We're going to have some fun. And I have Miles with us, who's our acquisition specialist and also team lead. He's been an integral part of Excite and will always be an integral part of here at Excite Capital. He's going to introduce us to some amazing strategies tonight. I cannot wait for Miles to get started. Uh, Welcome all again. Feel free to introduce yourselves in the chat, drop in where you're joining from, and towards the end of the session, we're going to have a Q&A where Miles is going to answer all your questions. So all our team at Excite is here to support you guys. Miles, take it away.
Hey, I definitely appreciate it, Addy. Give me one second. I'm just typing where I'm from, but I'll just let y'all know. So I'm joining from Memphis, Tennessee. Typically with these monthly meetups, we give a especially since they start at 6 p.m. Eastern, we give some of our people just a few moments to just trickle in. So in the meantime, if you do not mind, just drop in the chat where you're from.
Oh, we got people from Nigeria.
All around the world. We're nation international, Addy.
Oh, yes, we are. The other day we had this meetup. I remember people joining in from London, United Kingdom. We had some people joining from Australia. I didn't even know we were known in Australia though, but that was cool.
Yeah, that's amazing right there. Omnipresent. The whole world's gonna feel us here soon.
Yeah, James is joining from Washington,
James,
and then
it's been some time, James. I hope you're still out there underwriting some deals. I know you used to attend the underwriting warriors class. I hope you're doing well, James.
to people who don't know, James completed our course recently and passed 100%. So that was cool to see. Uh, James, again, thank you for joining.
5:03. Okay. We'll just give it a couple more minutes. I'll start at 5:05 my time. I'm in Central. You're talking about five o'clock somewhere, Addy. Central.
Oh yeah, 5 o'clock somewhere. We got a good number of people coming in tonight. Uh, this is going to be awesome, I believe.
Good. I'm looking forward to giving some value to back to the community.
Absolutely. This. All right, just a couple more minutes, guys. We're just waiting on a few people to join so that they don't miss the good part. Miles always
Absolutely.
starts with a huge bang, so we just want to get as many people in for that good start.
And then I've shared this when I led some monthly meetups in the past, but I actually discovered XI Capital and learned about XI Capital through this same platform. So it's always like an honor to come back and lead the monthly meetup because when I was still in the Navy, I would sit here and tune into some of the monthly meetups on YouTube. So it's like it's truly a full circle moment every time I get to lead these meetups.
Yeah, I think Excite has that quality in them because that's how I came to know about Excite, working for them, seeing them in one of the conferences, and just suddenly realizing, hey, I want to be part of this. So that's cool.
Absolutely. Well, I'm gonna go ahead and get it kicked off. Just
Yeah, let's go.
there's a few slides that we're gonna get to. I'm not sure I'm gonna take up the whole 40 minutes, but we'll see. But if there's any questions as I'm going throughout these slides, please drop them in the chat. From my window, I won't be able to see the chat right now, but towards the end, we will leave some minutes for like a little Q&A session. And then without further ado, let me just go ahead and hop into it. So, like Addy mentioned earlier, tonight we're going to be talking about just some key metrics that every multifamily investor should be tracking. We're going to be exploring these metrics, and I broke it down into three parts. acquisitions, operations, and then for some of our passive investors out there, we're going to be going over return metrics. Okay. And so these metrics are going to be used to screen potential deals. Once you acquire that deal, it's going to be used to monitor the property performance. And then to measure the success of any investment, we're going to go over the return metrics. Okay. So we're going to be discussing some tools and information needed to make data informed decisions. I'm really big on not making decisions based on emotions. The more informed you are about something, the more you're not going to have buyer's regret and all the negative things that comes with large purchases like investments. So data driven decisions is what I'm going to be focusing on right now. So success in multifamily real estate investing depends on understanding and tracking the right metrics. Throughout this presentation, we're going to be discussing a few different metrics. And this presentation is going to guide us through some of the essential numbers to impact our acquisition decisions, operational performance, and ultimately our investment returns. And before we dive into the presentation, just if you who are on the call today are unfamiliar with me, my name is Miles Hill. I've been with the team coming up on 3 years now. Later this summer, it'll be 3 years, but I'm a father of two amazing, beautiful children. And truth be told, they're the reason why I wake up every single morning and I go so hard. I'm My goal, just to give you all a little insight on me, is to set up generational wealth. I want to leave an inheritance not only to my children, and like they're only 8 and 3 years old, but I want to leave an inheritance. I want to impact the generation after them. So my goal is to leave an inheritance to my children's children. So multifamily is an asset class that I have discovered that is going to allow me to get there. So also been married for 10 years in June. So coming up on 10-year anniversary here soon. Um, my better half is at home taking care of the children right now. I'm over at the in-laws house where it's nice and quiet, so I can present to y'all without kids running in and out of here. But yeah, I'm a family man at the end of the day. They're my motivation. They're the reason why I wake up in the morning. They're the reason why I work with Excite Capital. And I started my investing career actually a few years back. So before I learned about multifamily and how powerful of an asset class was, me and my wife purchased our first single family home back in 2017. And honestly, it was a godsend. It was such a blessing to be able to own something. And I'm such a huge um c- like uh component of like ownership. But at the same time I realized that home ownership is going to be out of reach for so many people, and then in turn affordable housing is a crisis in this country. There's millions of houses that are short. People are going to be forced to rent. So though I am a big component of or and fan of home ownership, I realize that a lot of people unfortunately might not be able to ever own a home, and in turn they're going to have to rent multifamily units or other units, whether it's mobile home communities and such. But like I mentioned earlier, to add into some of the people who first joined, I actually joined Excite Capital through a program through the Department of Defense called Skill Bridge. So as military members are getting out of the military, whatever branch they're in, they have an opportunity to intern with a civilian company. So before I joined Excite Capital, I was actually an air traffic controller in the United States Navy, and it's like a complete, just different industry completely, right? I went from talking to airplanes to talking to investors. I went from landing helicopters to calling up brokers and asking them how much is this multi-million dollar listing. So there's a lot of parallels between what I used to do as a controller and what I do now. And one of those parallels is every day is dynamic. No 2 days is ever the same when I used to control aircraft. And now when I'm either working with brokers, whether it's insurance brokers, debt brokers, talking to investors, or analyzing these deals, no 2 days is the same, and I love how dynamic that this business is. And a little bit more about me. Some of my hobbies is hanging with my family. I told y'all about my children and my wife. Investing. I love to learn about it, investing, and then tending to my chickens. My mom hit me the other day. She said, "Hey, if you tend to your chickens, did that make you the chicken tender?" And that was like a little dad joke that my mom hit me with, and I was like, "Oh my goodness, I gotta write that down somewhere." And then another one of my passions is traveling the world. All right. And for those who are joining this meetup for the first time or who may not know too much about Excite Capital, I'm just going to give a brief overview. So far to date, we've acquired over $168 million worth of apartment, and we've acquired all of those assets through syndications. And for those who may not know what a syndication is, it's it's pulling resources, pulling capital from community members, family, friends, associates, and we're all pulling our capital, our resources together to be able to acquire some of these larger assets that a solo individual may not be able to take down by themselves. So, without further ado, I'm going to go ahead and jump to the next slide. Okay. And then if you notice that on the last slide, we had acquired 6 deals. Grove Park View is actually going to be our 7th acquisition. And it's a beautiful institutional quality great asset. The current sellers, they did an outstanding job of maintaining this property. So despite it being built in the late 80s, the 1980s, you walk on this property and you can see how well maintained it is. But it's 268 units. It spans over close to 20 acres, and we're at the finish line of closing on the deal. So we're so excited to be bringing this to our investors and to all of our investors on the call. On behalf of the whole Excite Capital investment team, I just want to personally thank you. You are the lifeline. You are the blood that runs through the veins of Excite Capital. Without you, Excite Capital doesn't exist. And without Excite Capital, I wouldn't be employed. So thank you so much for all of our passive investors who are on the call, for all of our active general partners who are on the call. Without you, we couldn't have acquired what we wouldn't be on track to what we're doing right now. So I definitely want to give you your kudos, give you your flowers, because it's incredible when a community comes together to be able to buy some of these larger assets. It's very powerful. But to transition over to today, we're going to be just talking about the key metrics to track, whether it's acquisitions, operation, or return metrics. And then once again, if there's any questions throughout this presentation, please drop it in the chat right now. And then whenever I'm done with the presentation, because right now I can't see the chat, we'll get all those questions answered. But when it comes to the acquisitions, the objective for Excite Capital is to locate underperforming assets in growing markets. And if I could just break that down a little further, I would say when it comes to underperforming assets, one thing that we do is we'll look at our subject property and then we look at the market. How is this subject property performing when it comes to other assets that are similar, apples to apples, oranges to oranges, to our subject property? And then if there's room for organic rent growth, then right there we have identified an underperforming asset. But to take it a step further, we look for those assets in growing markets. Okay. There's there's no point in finding an outstanding opportunity if it's in a bad location, because that bad location is going to take that opportunity and then just you shouldn't invest in something like that. So over the next few slides, we're going to be talking about some of the metrics that we track on a weekly basis, um, to ensure that we're bringing the best quality assets to our community of investors. But before purchasing any property, investors must analyze key data points to ensure a strong and safe investment. Acquisition metrics serve as the foundation for any successful multifamily strategy, okay? And before we dive into some of the metrics, I just briefly wanted to just throw the acquisition process on the screen. Sourcing deals is what we're primarily going to be talking about, but then you're going to do your initial analysis. A lot of the things that I do on a day-to-day basis is the screening process. We review thousands of deals throughout the year, and it doesn't make sense to send every single deal that lands in my inbox or I get a text message from a broker to send that property to be analyzed further, to be underwritten. So some of the metrics that I'm going to be talking about today is that screening process, getting some of the dirt out the way or some of the opportunities that don't fit our criteria out of the way, so we can focus our attention on the deals that do matter. All right, but the first metric that I wanted to talk about today is honestly is the most fundamental when it comes to commercial real estate investing, and that's capitalization rate, also known as cap rate. One reason why I wanted to bring this up is because it's also one of the most misconstrued metric that's out there. Sometimes, and honestly, when I first learned about multifamily investing, if you were to ask me, I would have told you a cap rate is the rate of return if you were to pay all cash for an investment. But here going forward, let's just get that definition out of our minds. A capitalization rate should not be looked at as a return metric, and in turn, it should be looked at more so as like a way to evaluate the price point of an asset. Okay. Um, I will touch on it here in a second since it's on the screen, but a higher cap rate generally indicates higher risk. And then on the other side of that coin, a lower cap rate identifies lower risk and lower returns. Here in a slide or two, we're gonna really break that down. But just to give you the formula for a cap rate, is gonna be the NOI, which stands for the net operating income. And once again, I know this is about key metrics. NOI is definitely a key metric that we're gonna break down further. But since we're on this slide, NOI is essentially the income that the property generates minus the expenses, whatever is left. You divide that by the purchase price, also known as the value, and you'll get your cap rate. Okay. And um, with the example that I use, let's say that we found an opportunity. I just got a phone call from a broker and he said, "Hey, I got a 100-unit building and the NOI is at the end of the year is $1 million. The seller wants 20 million for it." I could use those metrics right there. I know my NOI, I know my property, my purchase price. I could divide the NOI by my purchase price, and that's going to give me 0.05. If I just move my decimal point a couple times over, it's going to let me know that this is a 5% cap, or 5 cap for short. But let me see. When it comes to cap rates, there's a few different things that you can use them for. You can compare similar properties, which we'll do here in a moment when I break down this chart. You can also use cap rates to help this determine your resale price. And then also you can assess the market conditions, which I mentioned. Like if you see that a cap rate is relatively low in an area, mostly it's going to be like a class A area. If you get a property and the cap rate is super high, let's say a 10 cap, most likely you're going to be in a class D area, C minus area. So just seeing the cap rate alone, it can help investors identify, looking at this property, compare it to another property, and it also can assess the market conditions. Okay. And then, so how I mentioned that we look at thousands of deals throughout the year. Let's say that each one of these lines is a deal that we're reviewing. Okay. And the market cap is the column to the left. The property cap is the subject property that we're reviewing. What we can do to quickly, sort of like a smell test, to see if this opportunity is worth pursuing further, we can compare the market cap to the property cap. So if I take the difference between, I'll use this one right here. If the market cap in a particular area is 6.4, and I just got a deal in my inbox, and they're saying that the in-place property cap right now, going to say off the T3 financials, is at 4%, that's letting me know that this is an unrealistic seller based off of the market conditions. So the bigger delta that you see between the market cap and the property cap can just let you know, like, hey, let's not spend time on this opportunity. Let's focus on this deal that we got sent, that we're looking at the property cap and is right in line with the market cap. But if there's any questions, like I said, drop it in the chat and we'll definitely get to it later. The rest of these metrics that I'm going to discuss when it comes to the acquisition portion is what I use to screen deals. So I try to review at least 50 deals per week, and not all of those deals will I send to underwriting. Some of those screening things that I'm going to be looking for is the population growth. If you're a multifamily or a real estate investor, you need to know what drives demand. And the main thing, the number one factor that drives demand is the population growth. All right. So you never want to invest in a market that has a declining population. And to take this a step further, some of our criteria is, if I come across a market and let's say the population, let's say it's a tertiary market or a secondary market, and the population is less than 30,000, I'm most likely going to just pass on that deal, because there's most likely not a demand for those units that are coming online. Another metric that I utilize to screen deals is the median household income. And this determines the rent affordability in a market. And generally speaking, rent should not exceed 30% of the household income. And if you ever heard like the rent to income ratio, it should be close to 1 to 3, which aligns with that 30%. Also, and once again, I put a lot of information on these screens, and it's for like if people want to download the PDF later, this is a resource for you. Every time we have these meetups, we have these presentations. If you would like, um, yes, absolutely. You can have these presentations. I've been asked that in the past. And yes, I designed these slides for the viewers. So if you would like these slides just to have these notes, please feel free to reach out at any time. My contact information is going to be at the very end, but Yeah, absolutely. There's a lot of information on these slides, but it's for people to download later. Another key market indicator that I look for is school and crime ratings. So this can let us know a lot. So I'm gonna start with crime. So lower crime, it correlates with a more stable tenant base. And on the opposite end of that, let's say I received a property and it was in a high crime rate. Mostly, I'm just gonna pass on it. But there's one time I received an off-market opportunity. This was last summer, and I got the zip code, and I instantly knew that I was most likely gonna pass on it. But one of the most important parts about acquisition is just providing that feedback back to that broker. Like, say like they found an opportunity, and they're sending it to me, right? I'm gonna let them know like, hey, this doesn't fit Excite Capital's buy box because of X, Y, and Z. And so me just letting them know like, hey, I'm not gonna look at this deal because of the zip code. I took it a step further. So I plugged in the address into Google and tell me why the first thing that popped up was a recent shooting on the property. So not only is that going to raise insurance rates, if I lived in an apartment and there were shootings, I'm most likely not going to renew my lease. So it's key. It's so important to make sure that we're investing in safe neighborhoods with high school ratings because a higher rated school district is going to attract longer term renters. So, to really drive this point home, we're in the process of acquiring Grove Park View. And Grove Park View, the 268 unit asset outside of Atlanta, Georgia, is zoned for one of the top school districts in the state of Georgia. When we were on site doing due diligence, so this is like the process of walking every single unit, making sure that the things that we were underwriting, we can really sharpen our pencil. We can really get like hard quotes to firm up our numbers. When we were walking these units, we met a family, and they moved into this particular apartment because they wanted to send their child to the schools. So um, this is so true. Like if you are finding an asset in a great school zone, you're not going to have any issue with leasing up that apartment. And I'm just going to move on to the next one. So the next metric that I always check when it comes to reviewing opportunities, I want to make sure that not only like I want to have an understanding of what class asset it is, but understanding like what class neighborhood it's in. So if I could just go back a couple slides real quick to the cap rate slide. We mentioned that a higher cap rate generally indicates higher risk. A lower cap rate generally identifies lower risk. So if I jump to this one, if we could just focus on this chart real quick. So this is like the class of assets. So if I have a 2025 build, it's gonna be a class A luxury. If I'm looking at a class like a 1960s deal, a lot of deferred maintenance, it's gonna be like a class D property. And then if you notice, if we just look at the bar, the black bar, so it's gonna be to the left, is gonna be the risk level. The newer asset that just came online a couple months ago is going to have less risk. Therefore, the cap rate associated with this property is probably going to be 3, 4, depending on what market it is. And on the other side of the spectrum, let's say I had that 1960s deal, Class D, the fact that it has high risk associated with the cap rate on that 1960s deal is going to be far more than a Class A deal. And um, when it comes to asset classifications, I broke it down on the right side. You can sort of think of this, and it's not one size fits all, but I like to think of it as if I see a core asset, it's a class A. If I see a core plus, so what a core plus is a high quality asset, but it still has an opportunity to add value to it. I would consider that a mid tier class B property. And then class C, I align with value add. Value add has been the bread and butter of Excite Capital. Um, we find underperforming assets, we do strategic renovations to them, we add value, we lead with that. When you lead with value, value will come back. So we always lead with value. Excuse me. And then opportunistic, high risk, high reward potentially, right? And then when it comes to the capital, excuse me, let me turn this off. When it comes to the capital requirements, one thing I want to note before we move on to the next slide is the capital requirements is to acquire the asset. So when it comes to a Class A building, the capital requirements is going to be a lot upfront. But once you are managing that property, your operating expenses is going to be a lot lower. So this bar right here represents the upfront capital requirements, not necessarily the CapEx budget to or the renovation budget to get that Class D building where it needs to be. And then, so now we talked about the asset classes. Now I'm going to switch over to the neighborhoods. Okay, so before I dive into this slide, I just want to note that you can have a Class A building in a Class B neighborhood, and you can have a Class B building in a Class C neighborhood. Um, when it comes to the classifications of neighborhoods, I would just straight up say, unless it's your specialty that you want to go into these neighborhoods and really revitalize them, avoid Class D neighborhoods. There's a lot of headaches. You have to have a really sharp property manager to be able to run assets in these neighborhoods. So unless it's your specialty, once again, let's avoid Class D neighborhoods. This is just a screen grab from one of the tools that I use on a daily basis called REI Indicator. REI Indicator allows me to take my subject property, plug it in here, and then a pin will drop and it'll let me know what class neighborhood it's in. So class A neighborhoods, it's going to be more centralized. They're going to have upscale amenities. So you're not going to have to struggle when it comes to food options. That's when I think of amenities when it comes to neighborhoods, I'm thinking of park, recreational activities to do, food options, retail shopping. If you're in a Class A neighborhood, you might even be walking distance to some of these amenities. Class B neighborhoods, they're still well maintained. However, they might have a little older properties. They're more affordable than Class A, and there's going to be minor updates needed when it comes to some of the assets in Class B neighborhoods. Class C neighborhoods, if you sort of could think about it, like the center of a metro. So like let's say downtown Atlanta, where it's more centralized, you're going to see more Class A properties. And the further you get out of that metropolitan statistical area into the outskirts of it, you're going to start seeing more Class D properties. So once again, Class D neighborhoods, subpar conditions. So just think of low income areas, and it's so unfortunate. But when I'm doing my evaluations or screening these deals, I could always determine if the median household income is relatively low. 9 times out of 10 is most likely going to be in a worse neighborhood. So yeah, higher crime is also associated with lower income. And so knowing neighborhood classifications is so important because it helps investors assess the risk. It also helps us assess the tenant quality, the long-term appreciation potential, and it ensures that we are aligning with our investment goals. So if we have an investment goal, that let me jump back real quick. Let's say I have like an opportunistic investor goal. Maybe then I should be looking at Class D neighborhoods because that's where I'm going to be able to find a lot of the deferred maintenance. But once again, avoid Class D neighborhoods, and let's let like people who specialize in them focus in on them. The last acquisition metric is it's not really a metric, but it's part of my screening process is to identify FEMA flood zones. Okay. So anytime I get sent a property that's coastal, so I'm thinking like North Carolina, South Carolina along, or even Georgia, like maybe Savannah area, I always plug it into the FEMA website. And this is just a way to understand the like, risk assessments when it comes to these deals. But if y'all remember last year when North Carolina got hit with a hurricane that came up the Gulf of Mexico and it was inland, and there was a, like over it was like considered a 1,000 year flood. Ever since last year when that happened, when I get sent properties even in like inland North Carolina, I send them through the FEMA flood zone check. And it so happened I just like last month I got sent an off market opportunity. It was a beautiful property, well maintained. I think it was built in like 2021. Great debt on it that was assumable. Just from like the outskirts, I was like, okay, I'm definitely sending this one to underwriting. We got to analyze this one further. However, when I plugged it into the FEMA flood zone check because of the hurricanes that happened last year, I just wanted to check to see, even though this property was so inland, it happened to be in a flood zone. So we ended up passing on this particular opportunity because if you notice, it's in a special flood hazard area. And when properties are in these hazard areas, you can see your insurance rates skyrocket. So not only is it near a flood zone hazard area, it's also near a, which is represented in this little blue and red striped area, is a flood or regulatory floodway. So for whatever reason, if this floodway were ever to get extended, that water level is going to rise, and the backside of this property is touching that floodway. So whenever you get an opportunity, whether it's a single family home or a multi-family apartment building, take that address, go to the FEMA website. It's completely free. Plug it into the flood risk map, and then just to make sure you're making a wise decision when it comes to your investment. And just to summarize the acquisition metrics that we discussed, capitalization rate, once again, it's going to be the net operating income divided by the purchase price. We can use the cap rate to quickly understand, is this a realistic seller? Is this seller in line with the current market conditions? We can also use the cap rate to compare like properties. So let's say I have a Class C property, the cap is 5, and then I have a Class C 5 minutes down the road, and it's a 6. Okay, hold on. What's going on? Well, why is there a discrepancy and why is there a delta between the cap rates in the same market? So, cap rate is a great way to quickly assess an area. Also, let's stop thinking of cap rates as a return metric. Okay. We also discussed population growth. This is the key indicator to determine demand for rental housing. When it comes to the median household income, this determines the rent affordability. Crime ratings, you want to avoid higher crime rates. You want to seek lower crime rate areas. And when it comes to school ratings, better schools attract stable tenants. And there's actually a study that was done. Um, properties that are zoned I'm sorry, yeah, properties that are zoned in great school districts, they actually appreciate at a faster rate, and that's so interesting to me. But it makes sense. Also, let me see, neighborhood classifications. We talked about the A, B, C, D neighborhoods, and then the asset classifications. We talked about the core, core plus, value add, and then opportunistic. And then last but not least, we also talked about the FEMA flood zones, just to ensure that our property isn't in a high risk flood area. Okay, that was the acquisition part of this presentation. Here going forward, I'm going to be moving on to the operational metrics to track. Okay, and when it comes to the property performance indicators, all right, so after a property is acquired, that's when the fun begins. All right, there's a lot of work that takes place to be able to submit an offer, get your offer accepted, to do due diligence, to raise the capital, to really take ownership of that asset. And then honestly, all the work that went into just buying it, once you acquired it, that's when all the work also truly begins. So there's some financial metrics that we track on a weekly basis, monthly basis, daily basis, just to make sure that once we've acquired that property, it's performing correctly. So one of the most important fundamental indicators when it comes to the operational side is the net operating income. And you'll notice once you're doing more research in this industry, the NOI, as you notice, like the DSCR, which we'll talk about here in a moment, it needs the NOI. So let's break down what NOI means. We talked about it a little earlier ago, but if I could just explain it again. So gross income. So if we're talking about multifamily properties, the gross income is all the rental income. But let's also think about some of the other income. So let's say you have a property that has a parking garage and it's or covered parking. You could charge extra for that. So that's extra income. And there's a slew of other. Let's say you have a laundry facility on site, or you rent out washer and dryers inside the units. Those are former income. So what you're gonna do is you're gonna take the gross income and you're just gonna minus out the operating expenses, and that's gonna give you your net operating income. And this is essential for determining the property profitability. And one thing I'll note with the NOI, uh, we do not take when it comes to operating expenses, your debt service payments are not included in that. Okay, so the NOI is factored in before we consider the debt payment. Moving on to the debt service coverage ratio, this measures the property's ability to cover its loan payments. So if I take my NOI, which we just talked about is the difference between my income and my expenses, and I divide it by my total debt service, which is basically like your annual mortgage payment, right? So you make your mortgage payment every single month, but if you just times that by 12 and you annualize it, you'll get your total debt service. So if I take my NOI and divide it by my total debt service, is going to tell me my DSCR. And so just to break it down, let's say my net operating income was $1 million and my mortgage payment at the end of the year was $1 million. So 1 million divided by 1 million is 1. And that lets me know that that property is at break even essentially. If you have a DSCR of anything less than 1, even if it's 0.9999, technically that property is bleeding. It's losing money every single month over month. And then when it comes to conventional financing, typically lenders they require a DSCR of a minimum of 1.25, and it varies between lenders, but for the most part, conventional financing, we could go with 1.25 as a minimum DSCR that you would need. Another property performance indicator that we track on a daily or a weekly basis is the occupancy. And this just measures the percentage of the rented units. And this is fairly common. So let's say I had a 100 unit building and only 80 of the units were occupied. I could take 100 divided by 80 times about 100, and that's going to let me know that my current occupancy is 80%. The last metric that I have on this screen is this expense ratios. This helps us assess the cost efficiency and the operational effectiveness of our as we're managing this property. So you just take your operating expenses and divide it by the gross income. One thing I will say is the expense ratio is going to differ between markets, and also is going to differ between asset classes. So let's say I had a Class A building. I'm not going to have to spend as much on expense ratio versus a Class D property. Class D property is going to have the highest expense ratio. There's going to be a lot of deferred maintenance associated with those properties, and that's why those expense ratios are so high. But they typically fall anywhere between 45 to 60%. All right. Some other weekly KPIs that we track is on the screen. And just to give you some insight on how Excite Capital operates, on a weekly basis, we meet as the asset management team and we go over the weekly performances. And then the next day, we'll meet with our property managers and then we'll just obviously we're going to go over the numbers. Anything that stood out to us for that week, we're going to bring up. And some of those things that we talk about in these property management meetings are the gross rental income. Excuse me. So the GRI is the total income from rents across all the units. We also talk about the delinquency rates. This is the number of tenants that are behind on their rent. And we also talk about the total delinquent amount. Or is it 0 to 30 days late? Are they 31 to 60 days late? Are they 60 plus days late? Um, and then obviously, if someone's that far along with their late payments, we always work with all of our residents to see if we can get them caught up somehow. We work with our property managers to get them caught up. However, unfortunately, if they are delinquent, then we would run that thing eviction process. I don't know what my brain was lagging right there, but yeah. So that is one of the real sides of real estate. If residents are delinquent for over 90 days, obviously we're going to start the eviction process a little bit before that. We also track on a weekly basis the vacancy rates. So this is the percentage of vacant units compared to the total units. So if you remember on the previous slide, we talked about the occupancy rate. You can think of the vacancy rate as the inverse of the occupancy rate. We also track on a weekly basis the renovated units. And I put renovated units occupied, but it's really just like this renovation schedule. So let's say we're currently renovating 10 units. And then out of those 10 units, 5 of them have been made ready. They're ready to be leased up. We track how long it takes after a property has been made ready to being occupied. So that's something that we track on a weekly basis. When it comes to some of our marketing efforts, some of these next line items fall underneath that. So the total leads generated, the appointments scheduled, and at the end of the day, leases signed is that metric that we really focus on. Okay. Upcoming lease expirations is something that if you're a proactive operator, you want to be forward looking, right? So if we're in March right now, if let's say in April I had 25 units that were going to be expired, and I'm waiting until today to reach out to those residents to see if they're going to be renewing their lease, I am acting as bad operator. So one thing that we do is we have our I call it like a lease up schedule or lease expiration schedule, and it'll just break down January through December and how many leases are going to be expiring in those months. So if we're in March, we're looking at May, June, July lease expirations. We're proactively reaching out to those residents to see do they plan to renew their lease, and if they don't, we always love to see the reasoning. Are they buying a new house? Did we not meet their expectations? Was there something that happened while they were occupying this unit that they no longer like? We love that feedback because the more information you have, the better decisions you can make. So when it comes to upcoming lease expirations, always take a proactive approach when it comes to that schedule. And then, yep, some of the other things that we track: capital improvement progress, maintenance requests, online reviews and reputation, and then marketing engagement. Before I go to the next slide, one thing I will note is the maintenance request. This is another thing that we track on a weekly basis, um, because it has a lot to do with like the resident satisfaction. So let's say that every single first of the month you're renting an apartment, and you're making your payment, right? So you're upholding your side of it. As the apartment owner, if you got a maintenance request, that needs to be at the priority or the front of your mind until it says complete. Because if they're doing their part, making their payments, then you need to provide um, quality housing for these individuals, right? So we always check our maintenance requests um, on a weekly basis. And let's say someone owns an apartment community and they don't care for their maintenance request, most likely their online reviews and reputation is going to show for it. So all of it sort of connects, but I'm gonna go ahead and move on to the next slide. So these are sort of like the honorable mentions when it comes to the operational metrics that we track: loss to lease, turnover rates, rent growth rates, delinquency and retention rates. Um, I definitely wanted to include all these because all these metrics are very important. Um, but like as I'm poking my head into these asset management meetings, these is not something that we track on a weekly basis. However, we know what the rent growth rate is for our target markets. We know um, the loss to lease in our particular target markets. If I'm looking for a new opportunity, I have a post on that marketplace. So these are some of the things that we track, um, not necessarily weekly though. And then last but not least, this is one of my favorite topics, y'all. Okay, return metrics. So we have a community of investors who work hard for their capital, and they entrust Excite Capital to be a great steward with that capital. So ultimately, multifamily investments, they're judged by their returns. So it doesn't matter if you have a Class A building, it doesn't matter if you're in a Class B neighborhood, it doesn't matter if the median household income is over 100,000. If I have handed you 50, 100, however much money, and I expect um, a return from that investment, these next few slides is going to break down some of the return metrics that we should be tracking. Okay, so these metrics that we're going to discuss here in a bit is going to sort of go over about the ongoing cash flow and the total profitability. So I always look at returns in two different ways when it comes to multifamily investing. You have your returns from operations, and then you have your returns from the sale. And the proceeds from the sale, that's when most of the proceeds are generated. However, we talked about the NOI, right? So let's say we have positive cash flow month over month, and we're going to issue a distribution. That distributions comes from the operation of the asset. So let's break down some of these metrics. All right. So some of the top metrics that you'll see floating around there when it comes to investment opportunities, return on investment, equity multiple, average annual returns, cash on cash returns, and then one of my favorite ones is the internal rate of return. Um, I can't tell you the formula. I have to use an Excel sheet to understand the internal rate of return. I took a intro to macroeconomic theory class, and they sort of talk about. I'm sorry, I might be confusing it with the financial management class I took a while back. But anyways, I took a college class probably a couple years back, and it sort of broke my mind. I never thought about the velocity of money. I never thought about money as an employee. Like I am an owner of capital. I work hard for my money. I want my money to work hard for me. Money isn't my employee, right? So if I send my dollar out into the marketplace, I expect a return from that. So if we just break down some of these return metrics on a annual basis, so let's not think about the whole hold period. Let's just think about for like from January 1st to December 31st. Cash on cash return is the annual pre-tax cash flow divided by the total cash that was initially invested. So let's say I initially, just to use round numbers, um, let's say I invested $100,000 into an opportunity, and at the end of the year, I received $10,000 back. So if I take that $10,000 and divide it by that initial investment, which was 100,000, that lets me know that for that year, I received a 10% cash on cash return. Average annual return. And before I dive into each one of these, just know that there are some limitations for some of these return metrics. So I always like to look at all of them. So if you're just focusing on the average annual return, one of the limitations is, and which I'll break it down here in a bit. I'll give you the formula, then I'll break it down. So the formula for AAR is total return divided by the number of years that that investment was held, right? So let's say, just to use round numbers, um, I had a total return of 100,000. And just to make it fair, I'm going to use 10 years. So I'm going to divide that $100,000 return by 10 years. That lets me know that I receive on average, right, $10,000 per year. However, what if year three, there was negative cash flow, or there was a capital call, or there was just I didn't receive a return. Average annual return, its limitations is it just goes off the total return. It doesn't necessarily break down. Year three, there was negative return. Year four made up for it. So that's why I always say that when you're looking at these return metrics, always um, look at all of them together, right? One of the easiest return metrics to understand is the equity multiple. The formula for equity multiple is the total cash distributed to you divided by the total equity that was invested. So let's say that my initial investment, and we'll use the same number, 100,000, um, and I received $200,000 back. So I would take that 200,000 divided by that 100,000, and I'm going to get the number two. So my equity multiple for that investment was 2x. When it comes to the IRR, once again, I know the formula. I could Google it real quick and show you. It's very complex, but essentially it measures the time adjusted returns over the entire hold period. Okay. And then the return on investment is very common. Final value minus out your initial investment divided by your initial investment will give you your return on investment. And let me see, we've been going about 50 minutes now. So this is the last slide. Once again, thank you so much for your time. Um, my name is Miles Steele. I'm the team lead and acquisition specialist with Excite Capital. I'm so grateful for this company, for the platform that they created. Um, if you would like these slides, please feel free to reach out to me. One of my favorite things to do is connect with new people. So that's one reason why I love this industry. Commercial real estate investing is truly a relationship business, right? Whether it's you're forming relationships with an investor who's looking to place capital, or you're forming a relationship with a commercial broker who has a post on the marketplace, and any off-market opportunity, the fact that you have a relationship with them, they can send your way. It's who, not how. So it's not like how you do it, it's who you know to accomplish it. So if you're building some of the relationships with commercial brokers, insurance brokers, debt brokers, tax consultants, um, passive investors. Um, that's the name of the game. Building genuine, true relationships. But I'm going to go ahead and end my presentation right now, and I'm going to come back to you all. Give me a second. Let me see. Boom. How do I stop sharing? Maybe this one. Okay. All right. So it's 5:50 my time, 6:50. Let me see. Okay. So I don't see any questions in the chat right now. But yeah, if y'all do have any questions, please feel free to drop them in the chat. If not, I'll give it a couple minutes and then we'll go from there. Addie, you still there with me?
Everyone for joining. We're just waiting around for questions. Please drop me in the chat if you have anything. Just to let you guys know, if you do want to connect with someone at Excite and get more in-depth knowledge about investing or your past investment or just generally talk to plan out your future, I'm going to drop in a link in a couple of seconds. It's a simple form. You can just pull it up on your screens, fill out the information, and one of our experts will get in touch with you. Most likely it's going to be Miles, Alicia, sometimes Tenny and Leslie also drop in. So it's a great moment to be live. Uh, all right. Miles,
Okay.
we got a first question. Let me put up it on screen. Here
Beautiful.
we go.
Okay, so Yvonne, and I see that you were saying thank you for some other questions as well. Okay, hey, thank you so much, Yvonne, for attending. So Yvonne's asking about Grove Park View. How can they be a part of it? So Grove Park View is our seventh acquisition. As of right now, Grove Park View is only available to accredited investors. And an accredited investor is an individual who makes 200,000 or with a spouse they make 300,000. And there's one more criteria to qualify as an accredited investor, and that's a net worth of $1 million, excluding your primary residence. So these are rules and regulations that are determined by the SEC. So we have to abide by them. But if you are a accredited investor, well, Yvonne, whether you're a accredited investor or not, I would love to connect with you, and then we could break down Grove Park View. Um, yep, I definitely look forward to reaching out to you. Let me see. I see we have some other questions. Catherine, I definitely appreciate you joining. Thank you so much for the feedback. Let me see.
Miles, just one thing before we head on to the next question. Since
Mm-hmm.
this question was related to Grove Park View, for folks who are interested in generally learning more about Grove Park View, there are a few, I think, openings left on the raise. So I just put up a link on top of your screens. Feel free to click away. You'll get to know a little bit more about Grove Park View. And then, of course, there's a form. You can sign it up, and one of us will get in touch and get you up to speed on that. Having said that, we have our next question coming up from Bernard, and he's asking, does do these formulas work with smaller multifamily, example, 40 units?
Yep. Yep, Bernard, all the metrics that I discussed today, they work for any investment. If you were talking about the return metric formulas that I have on the screen, they work for any investment. So parking garages, multifamily, mobile home communities. Yep.
All right. Thank you. There's another question from Yuan. Is there a deadline for when investors can come in? I'm guessing she's asking about Grove Park View.
Yep. Yep. Yvonne, like Addie had mentioned, he dropped at the very top of the screen. If you see the Invest in Grove Park View to learn more, definitely fill that out, and then we can schedule a call to walk through this. When it comes to the deadline, we are finalizing the process now. We do have room for a few more select investors. So I will definitely get with you and we can discuss.
All right. Thank you. We got one more question. Which lenders do you use? Marvin Gunn. Uh, so this is a question from Marvin on LinkedIn. Which
Mhm.
lenders do you use?
Okay. So when it comes to Grove Park View, we are actually assuming a Fannie Mae loan, and who is facilitating that loan is Barcadia. In the past, I've know we have a great relationship. I don't think we've done any deals with Newmark, but have a great relationship with some of the Newmark debt brokers. JLL is a company who we've financed through. I want to say CBRE as well. So CBRE, JLL, Barcadia is doing our financing on Grove Park View. And then we haven't got a deal with Newmark just yet, but Newmark is I'm talking about over the last couple of years, we've been building a relationship with some of their debt financing team. So we hope to get one through them as well. Greystone as well. They're a lender that we go to. We have a great relationship with. Um, Hope I'm not missing anyone. But yeah, CBRE, JLL, I know for sure.
All right. Thank you so much. Uh, Folks, keep the questions coming. Fella, if you could go back to LinkedIn and check if there's someone with a question there. Okay, we got another question from Bernard. Uh, when do you anticipate Grove Park View to be closed? That's a really interesting question.
Yeah,
So I
and
think
that
Miles can
I
take
love
care
all
of
these
that.
questions coming through, Addy. But Bernard, Yvonne, everyone who's watching right now. Melvin, thank you for watching in on. Marvin, thank you for joining in on LinkedIn. I definitely appreciate all these questions. So for Bernard, he asked, when do we anticipate Grove Park View will be closed? So Bernard, we've actually already raised enough capital to close on Grove Park View. Right now, we're just finalizing the reserve and renovation budget. So there are a few select spots left. I anticipate Grove Park View will be closed this week, but when it comes to joining the ownership group, maybe the next couple of weeks.
All right, cool. So, all right, I think we took care of most of the questions here.
Mhm.
Fella, do we have anyone coming in from LinkedIn that we need to take care of? I think there's one more. Uh, who handles your property management? This is again from LinkedIn from Marvin Gunn.
Hey, Marvin, thank you once again for asking this. Like, who handles our property management? So, across our portfolio, most of our assets are in the Southeast. However, we do have a couple of properties along the Mid-Atlantic. So, we have a property in Maryland. WPM, they manage those properties. When it comes to any asset that we receive in the Southeast, our property manager is Asset Living, formerly known as First Communities. And once again, how I mentioned, commercial real estate is a relationship business. We've been building a relationship with some of the leaders of First Community or Asset Living for the last 6 years. So one of the great things about our relationship is once we are pursuing an opportunity. So let's say a broker reaches out to me and say, hey, Miles, I have an off-market opportunity. I screen it. It meets our criteria. The population growth is there. It's in a safe neighborhood. The school districts are great. The medium household income fits our investment criteria. I send it to Manny. He underwrites the deal. Typically, he'll need some clarification on something with the market. That's when I reach back out to our property manager. I'm like, hey, what do you think about this opportunity? And that's when they unveil everything. They let us know, like, hey, Miles, I see that you're penciling this. Let's change it to this figure. Or in this particular market, we're seeing rent growth at this rate. Let's change this in your underwriting. So our relationship with our property managers is so like essential to our success because not only do they manage our properties after we acquire them, they help us acquire properties. So um, yeah, we have to build relationships with property managers if we're looking to excel in this space.
Perfect. Thank you so much. Fella, do we see anything else? I don't have any questions here from this side of the world. All right, we got one more. Uh,
Okay,
okay.
fulfill.
All right. How are you on UW insurance and or real estate taxes? All right.
Okay, you got it on the screen. So fella asked, how are we underwriting insurance and real estate taxes? So I am not the underwriter. I am part of the acquisition team, so I will give you some insight on this question. But when it comes to like underwriting, that's not my forte as of now. When it comes to insurance and taxes, so we have a great relationship with one of a tax consultant, And last year he sat down with me and our underwriter, and he went through all the markets that we look at and the tax renewal rates. So it to answer your question, it depends between what market you're in, and especially with insurance. So if you're looking for insurance in Florida or even some parts of Texas, like Houston, like if you know Houston, Texas is on the Gulf of Mexico. If you're looking at any property on the east side of the city, you can see some pretty steep insurance quotes. So when it comes to underwriting for insurance and taxes, my direct answer to you is it's going to vary between market to market.
All right, thank you.
And then, Addie, before we go to the next question, just to give some more insight for this one, but always reach out to an insurance broker and a tax consultant if you're looking about placing an offer, because these are literally the largest operational expenses. Insurance and taxes can kill any deal. So if you're unfamiliar with a particular market, you could always call up to that county or that city and ask them like, hey, how do you evaluate acquisitions, or like if I purchase this property for this amount, what will my estimated taxes be for next year? Have those conversations to ensure that before you submit your offer, your pencil is as sharp as possible.
Just a quick update. We have Manny joining us to answer your tax-related questions. He's an
Nice.
expert on that side. So it was so amazing to have him in here. I think he's joining us momentarily. Manny, if you can hear me, you're the presenter now. So just turn on your camera and mic and join us. Okay, let's do this. So while we wait for Manny, probably he's getting set up. We have another question from Bernard. Uh, is it spread out or capital among multiple multi-assets or going all in one?
That's a great
What's
question, Bernard. So for Excite Capital, for all of our deals that we've done in the past, so this is gonna be our seventh acquisition. They've all been standalone deals. So like spread out. Let me see. Let me just read your question one more time. Spread out capital among multiple assets. Correct. So, um, that's how it is. So if you invest in Grove Park View, you're solely investing in Grove Park View. It has nothing to do with any of the other assets that we've acquired in the past. Um, XI Capital, in the future, we do have plans to have a fund. The fund structure works where you invest into the fund. Let's say that fund owns 5 properties. The performance of all those assets is going to determine the outcome of your investment into the fund.
all right? Thank you so much. I think we have a couple more. Okay, this is Marvin from LinkedIn again. Last one, how do you spec the cost for improvement for value at play?
Yep. Hey, man, Marvin, please feel free to ask 10 more questions. I definitely been enjoying your questions. But when it comes to, let me see, how do you expect the cost for improvements for value add play? Great question. So, and I'm pretty sure Manny can definitely give a little bit more insight on this answer. But if I was going to answer it directly, I would say reaching out to our property managers. And there's, it's like, say we own an asset in that market already, we have a great understanding of how much it's going to cost to renovate flooring or get in there and update the kitchens and bathrooms. So that's why a lot of our target markets are markets that we already own in. So Atlanta, Georgia, for instance, is a market that we are very familiar of. So when it comes to specking out those costs for improvements, we have a I'm trying to think what it's called. Yeah, I'm trying to think what it's called. We sort of have a table that goes off of for kitchens in this market this amount, and sometimes our property managers will give us like, hey, for this year let's change up some of these costs for some of the renovations that we planning on doing. So leaning in on our property management or our property manager, they can definitely give us a update like, hey, okay, I see that you're underwriting $15,000 for these units. However, these units are smaller. Let's budget 12,000. So I would say our property manager.
All right, perfect. Keep it coming, guys. We're having a great time answering your questions. Uh, we're just trying to get Manny set up. Want to change status. Okay. Manny is presenter. All right. Okay. Another one. Can I see
Yeah,
another
so we
question?
got a question from Bernard. I believe this is like a follow-up question on if it's best to invest in a single asset or a fund. And Marvin, I should have gave a disclaimer earlier. I am not a financial advisor. I'm not a tax advisor. So when it comes to the best thing to do, I honestly can't answer that because it's gonna vary between person to person. Your risk tolerance might be completely different from my risk tolerance. So, um, I will say when it comes to investing in a fund, you are spreading out your risk across the fund. When you're investing in a single asset, um, all of the risk is in that asset. So you just need to evaluate each opportunity, standalone. That's a great question though. But I hope you understand where I can't, uh, I don't know your financial situation, so I can't give financial advice. Is and Addie, I know you're working on getting many in, so I'm just gonna read them off the chat right now. Bernard asked a follow-up question again. Is the investment fund like a REIT? And then if so, who underwrites deals at Excite Capital? So the second part of your question, Bernard, Emmanuel Awasom, he underwrites our deals. I think he's maybe having issues joining, but he's be coming in a second. And then is the investment fund like a REIT? So um the way I always answer questions typically is this. So like a REIT is just a publicly traded company. So that REIT may own retail centers, like retail shopping centers. One REIT might go after industrial, so like warehouses. Some REITs might go after medical offices. Some REITs might go after multifamily. So it's gonna be determined about what REIT you're referring to. But yeah, they all sort of do the fund structure where they're investing in multiple different shopping centers or a whole bunch of assets within that same fund.
Okay, thank you. There's something more. Okay, we already answered that. All right, Manny, we have Manny in here.
Manny.
Oh yeah, sorry, I'm at work, so sorry, I was trying to figure that out. What was the question? I can.
Let me see.
Yeah, we're going back to that. It was from Marvin from LinkedIn, so it's up on the screen.
So, Manny, how do you
How do you
underwrite?
underwrite? It for insurance, it just depends on the risk that Miles kind of mentioned. A lot of times when you first start, you have to work with an insurance broker just to kind of gauge around what um, an estimate the insurance will be for certain areas. Over the past, I would say, a year or so, insurance has double or triple in certain cities. So before in Georgia, we're underwriting for say $600, just like a preliminary. Now we'll be underwriting for $1,100 or $1,200, but that varies. So when you find a deal that's penciling closer to asking and you request like an insurance quote because you don't want to request it for every single property that you screen in, then based on that initial insurance quote, you can kind of use that as a guide going forward for your deals in that market. So insurance can be tricky. I would say for your market when you first start, try to work with an insurance broker just to get that initial estimate. Then you can use that estimate going forward. Obviously, once you find a deal that you pencil closer to asking, you're gonna need to get a preliminary insurance quote to move forward, just so you're more confident. Um, taxes is one of those things where once you first start underwriting, one of the main things that I would say is that you want to understand how taxes are assessed in that municipality, because for every single municipality, taxes are assessed differently. For some counties, taxes are assessed every year. Some counties every 4 years, every 6 years. So the first thing you want to understand is like, okay, when are taxes assessed in that county? Is it assessed every year? or is it on a periodic basis? So that's the first thing you want to know. The second thing you want to figure out is, are taxes reassessed on sale? Because for some counties, they might be on a periodic basis, but even when you purchase that property, it's not reassessed. They have this periodic schedule where you have to follow when reassessing taxes. But for some states like South Carolina, taxes are assessed, depending on the county, every 45 years. But on sale, it's that reassessment is immediately triggered. So you have to figure that out. So you have to figure out the reassessment cycle, and then you have to figure out something called a millage rate. So to estimate the taxes, you try to figure out what the county uses to appreciate. Some counties will appreciate the value of the property by 100%, 95%, and they'll multiply that by the millage rate. And they also have something called an assess rate. So the three things you need is like the appreciation percentage, the millage rate, as well as the assess value. So you might have like a 100% appreciation for the taxes multiplied by the millage rate, and it's assessed at say like 40% for some counties, say like North Carolina or something like that. Actually, North Carolina is 100%. But so knowing when taxes are assessed, if a sale triggers that reassessment, that millage rate that changes on an annual basis, depending on the county. If you cannot figure out the millage rate, the easiest thing to do is to call the tax assessor's office. And even if you can figure out how taxes are assessed, don't spend your time trying to figure it out. Just find the tax assessor's office for that county and call them and ask them, hey, I'm purchasing this multifamily property in this county, and I'm just trying to figure out how taxes are assessed. The main thing with doing that is that once you figure out how taxes are assessed in that county, for any multifamily deal that you get, you can run that same process for estimating the taxes. Obviously, once you're going forward, trying to put in your LOI, you want to get an actual preliminary tax quote. But for the most part, based on the deals that I've underwritten, your estimate, if you're doing it correctly, if you're following how the county, the municipality assesses taxes, will come very closely to what that tax assessor would give you. But you always want to give that, because once you go into your LOI, they're going to ask you if you had obtained a preliminary tax quote, and you want to have that document in it. But if you guys need any additional questions on that, or if you want to figure out how to figure out taxes, we can schedule a time to go through that. But the main things you want to know is like how often a tax is assessed, is it reassessed on sale, what's the millage rate for that county, and what's the assessed percentage for that county. And then putting all of that together, you can figure out the taxes.
Awesome. Thank you so much. Miles, I'm going to take a couple of questions and just kind of recheck with you if you answered them. So
Okay.
Bernard had this question. I think we answered them, right?
Yeah, we got the REIT question answered.
All right. And there was one about spec the cost for improvements or value at play. I think we got this one as well.
Yep.
Uh, all right. We got one more. And this is, give me a second. So this is coming from Bernard again. Do lenders underwrite the deal to determine the asset risk or take the GP word for it?
Now, trust but verify, right? So they're gonna trust us that we're bringing them a deal that probably meets the minimum DSR requirement. But absolutely, before let's say Bernard, if you were about to give someone, let's say $30 million to help acquire this asset, are you going to evaluate that deal to determine your risk as well? So, to answer your question directly, absolutely. Lenders underwrite deals. In fact, they have multiple underwriting teams. So it'll be a preliminary underwritten, and then it'll be the next phase after that, and then it'll be finalized. The senior underwriters will look at it. So they definitely underwrite it multiple times.
Awesome. Thank you. We got one more from Marvin. Marvin's asking all the great questions today. So we got, uh, oh,
Uh-oh.
wait a second. All right, here we go. Have you required any capital calls from previous investments?
Yep. Marvin, like you mentioned, Addie is asking all the great questions. So Marvin, Excite Capital, we've been established going on 6 years now. In those 6 years, we haven't issued a single capital call for any of our previous investments.
That's I think where Excite is doing things right, I believe, right? So even in the toughest markets last year, none of properties went into that situation. So I love that. Hope that answers your question, Marvin. Uh, Keep it coming, guys. We're gonna give it a couple more minutes. If you have anything, please feel free to throw it at us.
Hey, Addy, I'm still here. I'm about to just go off camera real quick. I need to plug up my laptop before I lose this whole thing.
Yeah, you do that. We don't want to lose you. So everyone who's still with us, and looks like there's a lot of people with us. Again, we appreciate you joining this evening, taking the time out. It's always good to have uh, all of you people join us where we can share some value of what everyone at Excite has learned over the past few years. Um, if it helps you guys in any way, then our work is done. Then we've achieved something this evening. So again, thank you for joining. I do not see any more questions coming up, but all right, Miles. So we don't have, I don't think, oh, wait, someone's typing. So let's give it another second.
That sounds good.
Uh, okay, that's another great question. So Bernard is asking, when is your next meeting?
Okay, so Bernard, thank you for this question. So we always hold a monthly meetup, the same platform that we're on right now, the first Monday of the month. However, and then Addie, maybe you can get some more insight on some of the other Thursday meetings that we
Yeah.
have. We Bernard, we have a Beyond the 9-5 community where we also have meetings. But Addie, can you inform us on the next meeting? Is it this Thursday or the next Thursday?
Yes. So, just for everyone who's, just for the sake of knowledge, for everyone who's joining us, I know some of y'all have been in past meetings. So, every Thursday at Excite, we do what is primarily a passive income meeting where we kind of give you deeper insights into why we do this, what's in it for professionals coming in while keeping their jobs, what is the best way to get into the passive income stance once and for all, and use all that money that we've collected and saved over the past years, and set us up for a beautiful retirement. So we do that every Thursday. Y'all are welcome to join. If someone in the team can drop in the link to that, I will be super grateful. I'm also pulling it up as we speak. So if anyone's interested, we have it at Thursdays, 7 p.m. without fail every week, and it's at 7 p.m. New York time. So that is one uh, webinar where you can join us, learn about your next steps. I just dropped in the link if you want to register for that. But besides that, watch out for these monthly meetups the first Monday of every month. And then watch your inbox. We do a lot of tax strategies where we have CPAs coming in. If you go to our Beyond 95 community, which is www.beyond95club.com, I'm going to drop the link here as well. Uh, so what do you find in our community is a collection of all these things that we've done in the past, and it gives you access to kind of a whole library of videos and a lot of good stuff that if you're leaning towards learning about multifamily, you could do it there. We took almost goddamn 3 years to create a beautiful course which teaches you it takes you from a novice to an expert in a matter of like 4 weeks. So some of the people who are present here today took that course, and I'm pretty sure we provided some value on that. So we got a good amount of stuff going on the club. I just put up the link on top. But besides that, we got these webinars, meetups going every week. Watch your inbox. We send it out to all the people on our database, and everyone who's present with us today is definitely going to get emails. Just just a quick note, if you haven't had a chance, please take a second after this webinar, go into your inbox and mark us as a safe sender or add us to your whitelist, because sometimes we send a bunch of emails and abruptly, like without any reason, it ends up in junk. And we have had people who call us back and say that we missed it. So please go in, add us to your whitelist so that you never miss such an amazing event. And we got a YouTube channel. So someone in our team just posted that. We got a YouTube channel. All of the good stuff is posted there, plus a lot of bunch of knowledge from Leslie and Tenny. So they keep posting really good stuff if you just want to take bits about the industry, about the stuff that's happening currently. But all of us here are excited to, excited and excited. Well, we're excited to get you good stuff going on. And then again, these meetups, specific meetups, are Monday every month.
Oh, the first Monday of every month.
First Monday of every month. Yeah, you're right. That 5 o'clock somewhere doesn't apply here, right? although I must say, we're so many places that you will find us. You cannot miss Excite right now. So again, guys, thank you. Miles, over to you if you want to share the last note.
Yeah, absolutely. If y'all are still listening in, I want to thank you so much for the opportunity just to present some information in front of you. I hope you got something out of it. If you would like to, and I can start typing my email in the chat. If you would like the slide presentations, I could definitely provide that for you. Along with my email in the chat, I'll provide my cell phone number. I have a work number, but I cannot think of it off the top of my head. So please feel free to shoot me a text message if you would like to set up some time, and we can discuss multifamily investing, because it's such a powerful asset class. And man, I honestly, I wish I knew about it earlier. And I always look forward to having conversations with other investors to hear about their investment goals, some of their investment strategies. So please feel free to reach out to me. I dropped my email and my cell phone number in the chat. And then I could definitely provide some of the information. We can go a little deeper.
Oh, absolutely. Absolutely. And guys, you have Miles' contact phone number, you have the form. Please do not hesitate to reach out. Even if, quite frankly, even if you're not planning on investing, just learning, or just have questions toward investing, or maybe planning your future, do not hesitate to reach out. Our goal is not just to help you invest, but also plan in a better way your retirement, your future. So please do not hesitate to reach out in any way. All right. So I think, Miles, we got all the questions. We got everyone in. You want to close?
Well, hey, same time next month, y'all. First Monday of every single month, Excite Capital, we have these monthly meetups. Not sure if you heard earlier, but this is how I actually discovered Excite Capital, or at least how I learned more about Excite Capital. So I'm forever grateful for this platform, for all of our investors and partners on the call today or listening to this later. Thank you so much. I mentioned it earlier. It definitely deserves a second mention. Without our community of like-minded investors, Excite Capital would not exist. So far, we've acquired 7 properties that is going to be totaling over $200 million. And we would not have been able to do that without the relationships that we built. So to you, I just want to say thank you so much. We're forever grateful, and stay safe out there, and we'll see you next month.
Awesome. Thank you, guys. Hope you have a great rest of the evening. Thanks for joining in.